I'm looking to outperform the S&P 500 by investing in high quality individual stocks in my portfolio, and today I'll be diving into my £53,000 plus stocks and shares ISA on Trading 212 and why I'm trying to grow this particular holding to well over £100,000. All of my holdings are monopolies or have a competitive advantage against their peers with a history of fast growing free cash flow. I'll be talking through my holdings, why I chose them, and things I'll be doing to grow this portfolio over that 100k. If you get something out of this video, then don't forget to leave a like and consider subscribing to the channel to help it grow. So this is my overall portfolio, and we have an overall value of £53,600 or so, with a total return that's upwards of about 4k right now, with a rate of return of about 19% over an extended period of time, which was around about in May 2023 when I first started investing in this ISA. And more recently, I've massively tried to grow this portfolio into the future. With an overall value of around £6,800 just last year on the 1st of April, I've massively increased my contributions to try and hit that 100k mark. And I want to share with you guys why. The main reason is because of compounding. In this particular case, we have a savings versus investment returns graph. And this is on the road to $1 million. In this particular case, the individual saves around 10k in annual savings and contributes this to their portfolio. And they get around a 7% annual interest rate return, which is the average growth rate for a global index fund. In this particular case, the individual is able to grow their portfolio over 100k from these 10k annual savings and the 7% annual interest rate in around 7.84 years, which takes the longest over this period of time. After that, it slowly takes less and less time for them to increase the overall value and double their portfolio. In this particular case, it takes around 5.1 years to get from 100k to 200k, and so on, getting less and less until we get to 900k to 1 million, where the overall savings has less of an impact, and it takes only around just over a year to get 100k, the original value of this portfolio. We can see the impact of the savings versus returns right here. Savings initially before this 100k period have more of an impact than the overall return. However, as the overall value of the portfolio increases, those savings has less and less of an impact, with the returns accounting for more and more of the overall value. As it states down here, when you increase your net worth from 100k to 200k, say, in this particular example, we get a 51% return of that increase will come from savings, your contributions, and 49% will come from your investment returns. What this graph is really saying is that as time goes on, as your investments actually increase in overall value, your contributions matter less and less, and your wealth continues to compound because of the investment return you're actually getting rather than your contributions from, say, your national income or your job. So that is why we're contributing so much so quickly. We want to increase the rate at which we get to that 100k, rush towards it almost, so that we can take our foot off the gas, stop contributing so much to this portfolio, and let compounding do the work for us. In this particular case, we've gone in little over a year to around £54,000 now. And that wasn't the case around a year ago when I had about 6k invested. So I've massively put my money where my mouth is here. And this is certainly true more recently. We can see my overall deposits has hit about £49,500 with no withdrawals in this account. And more recently, especially on the 7th of April, because the new tax year started, we've seen that my deposits and transfers from my invest account massively increased, adding around about £8,000 in around about the space of a day. And this is mainly because I was saving into my invest account, where I was letting my money continue to compound through investing in stocks or just keeping a money growth rate of around 4.5% through money market funds. So this is the beauty of Trading 212 in my opinion, because I continue to compound my wealth, keep adding to my overall sum, and it can continue to compound at a quicker and quicker rate, hopefully. But I am limited in what I can do. Here we have the ISA allowance for this year, and I've already reduced it by a massive amount. We have around about £8,700 already used, and we've only got about £11,200 that we can contribute to this account before we can no longer contribute enough for this year and have to wait till April 2026. But I'm not letting that slow me down. If I can't invest in this account, I invest in my invest account, the general account. And if I had particularly good gains, which, don't worry, I don't always do that, then it wouldn't matter and I'd have to pay capital gains tax. And that's usually over around about £3,000 in the UK right now. And you're probably thinking, that's great, but your future returns are uncertain because you invest in individual holdings, and you will be right. Now, they may continue to outperform, they did in the first year, but that has no real factor on what will happen in the future, as nothing is certain, especially in investing. Just because something happened in the past doesn't mean it's going to happen into the future. In this particular case, I've invested in individual holdings just like this. And they're mainly there because I believe they will grow at quicker rates than your average S&P 500 investing holding, which usually grows a lot slower than these ones. In this particular case, I invest in Amazon, which is around about 25% of my portfolio. We have Brookfield Corporation at over 20%, Google that is around 10 to 12%, and Visa and ASML, which are around about 8% of the portfolio. Then we've got S&P Global, which is a ratings business, Mercado Libre, which is an e-commerce business in Latin America, Brookfield Asset Management, which is part of Brookfield and is an asset management firm that I recently have as my newest holding. And then we've got Texas Roadhouse, which is probably one of my longest term investments, and Hims and Hers, which is a roller coaster of a volatile stock. So all of these holdings, in my opinion, have the potential to increase their earnings at a quicker rate than the average S&P 500 holding, and this means that they will likely outperform the market. But nothing is certain. In this particular case, I like to focus on the fundamentals of businesses, more focusing towards their profitable free cash flow per share as a price to free cash flow as a main metric, and their earnings per share or price to earnings, and avoid looking at the share price for my answers of how well or how badly a business or stock is performing. But investing in individual holdings can be very tricky, and I tend to have an investment thesis for all of my holdings, all the way from the smallest like Hims and Hers to the largest like Amazon. In Amazon's particular case, I focus on their moat, which I believe is highly competitive and likely to outperform its peers. It has brand and customer loyalty, it's number one in e-commerce provider in the US and Europe, number one in cloud service provider in the form of AWS, where it has a dominant market positioning and is growing around about 19% year over year. Number two in streaming service provider in the form of Amazon Prime. Number three in advertisement revenue at the form of 19% year over year. In Amazon's case, the higher margin segments of the business are leading to greater profitability, with fast growing free and operating cash flow. To reinforce this further, their revenue growth is very predictable and has increased at a massive rate, even though it has slowed down in more recent years, but still sits above 10%, with their last quarterly revenue value sitting over $187 billion. Meanwhile, their growing profitability is starting to show, with Amazon's cash flows starting to look better and better. At the moment, their cash from operating activities has grown about a 36% CAGR over the past 3 years, all of which feeds into the share price. As revenue growth continues, even at a slower pace, and their growing profitability looks slightly better, we start to see that shareholders start getting rewarded for owning Amazon shares through share buybacks and maybe even a dividend. This will massively increase Amazon's share price and hopefully make it outperform the market. Over the past 10 years, Amazon has massively outperformed the S&P 500, with it up over 748% since 2015 all the way to 2025. But does that mean it's going to work for this portfolio? Who knows? It's my thesis that it will, and I'm looking forward to sharing this journey with you guys. But as I said, my main reason to focus on that 100k is so that my contributions can be less and less as time goes on. If you like this video, then please consider leaving a like because it does really help me out. But thanks for watching, and I'll catch you in the next one.